Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's December 11th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast. So bring the headlines and tell you what's really moving these markets. So, a great interview for you today with the best analysts, best podcast hosts, money manager, and most handsome person in the world, president and founder of Horowitz and Company, great friend, Andrew Horowitz. What's going on, buddy?
Hey, Frank Curzio. You know, I got to tell you something. That was very nice of you.
That was nice.
I would say the same if you were coming on my show. You know that.
Oh, yeah, I do. Hey, I came on your show a couple weeks ago.
Yeah.
I say it a
picture.
Good
chat.
More important. This is much more important than anything we're going to talk about today, okay?
Okay.
What is this about?
Oh.
If you're on YouTube watching
right
this is a marlin that, look at you, look how skinny you are there. What do you have, like a Zep pound with one cheek and a Majaro on the other cheek?
Yeah.
You must almost like 50 pounds, man. You look great there, seriously.
I got Ozempic Tuesdays, I got Zep-bound Wednesdays, I got Majorno Thursdays. It's unbelievable, you know?
Look at the size of this. How big is it?
So that's about a 250-pound blue marlin, Pacific blue marlin that we caught. Wow. That was a good fish. Did you see the tuna? You have the picture of the tuna?
I do. I think I have the picture too somewhere. I could probably bring it up. Yeah, but that's amazing.
That tuna was tuna took 6 guys, 2.5 hours,
holy
6
cow.
rounds each to bring up. It was a beast. It was like pulling a Volkswagen out of the water.
Wow. Yeah, if you guys watch this on YouTube. Is that your boat?
No. That was down in Guatemala. I go down to Guatemala once a year, hopefully maybe more, with a bunch of guys, and we get a boat at this place called Casa Vieja. If you have your listeners the opportunity to look it up, it's a wonderful. It really is. I mean, if you could do this, it's a bucket list trip. It's a wonderful trip, and they make it so easy. You get on the boat, you fish. You get off the boat, you get back to the lodge, you get a massage, you eat dinner, you have drinks, you play poker, you smoke cigars, you go back to sleep, you get up, do it again.
That's great. See, I can't wait to. I'm part of the 1% like you know.
I see.
Yeah, just for a quick, quick reference. Andrew, when he goes away, he's always sending me pictures of his fishing and food. Right. So if you go to his website, it's fantastic. Even when I think it was on your podcast.
Frank Fishing and Food is my favorites.
Yeah, I was on a podcast a couple of weeks ago on your podcast, and I'll bring up that website in a little bit. But the notes were like Frank Curzio, and the next one was like chili cook-off contest, and that was the only note. So I was like, that's all I want to see. I want to listen to that part of it, which is really cool. But man, it sounds like you're having a lot of fun, man. You can tell. It just sounds like things are really good, huh?
Working hard, playing hard, but doing, balancing really well.
Yeah, new studio. Looks good in the background.
Got a picture of Fort Lauderdale in the background there going. It's supposed to be out my window.
Wow.
But it's just a nice view of Fort Lauderdale, what it looks like. Actually, it's a little bit old. That's probably a few years old. There's a few more buildings in there, but that's the best one I could find to stretch out behind me.
No, that's really, really cool, man. Seems like, it's really nice. So let's get to the markets. And I guess I want to start with the Trump bump, what they call it, right? The last month has been incredible. It feels like everything is up higher. From Bitcoin going to 100,000, Bitcoin's up over 40%. Lots of stocks are doing very, very well. I wanted to talk to you and bring on the podcast because fundamentally it's hard to justify, right? People are like, this is expensive. What about from a technical perspective, which you look at, because we're seeing that I read someplace that if you're looking at investor sentiment into stocks, it's at a 40-year high. How do you look at that from a technical perspective? Because it seems to me a lot of stuff's breaking out. You have a lot of momentum. Earnings have been pretty solid. You got interest rates probably coming down. How do you play it from a technical perspective? Because it sounds like people are worried, but they're staying in this market.
Nobody wants to get out. Let's just get that straight. Nobody wants to be the fool that didn't go along with the ride here. And if you look at trends and you look at the ability for markets to maintain the directionality of where they are. I mean, you have to decide with the fact that markets are, in fact, trending higher. I mean, it's not a question. It's just a fact. Even little intraday blips on the downside can't really derail things. You can't have, issues in China or issues in France or even what's going on in South Korea. It seemingly has no effect on our markets right now. And the big reason for that is, again, FOMO. Nobody wants to be outside of what they think or perceive what is being told. Because if you look at the media, that every day they're talking about, well, deregulation and a friendlier environment and the opportunity, lower taxes, all these things are making for a really good story for the markets. A good friend of mine, Brian Shannon, always talks about, the trend is a much easier to follow as long as it's going for a long term than turn. If you're in an uptrend, why bother doing anything and trying to fight it? So right now, I think there is a good amount of sentiment that is, I would say, overly enthusiastic. Considering also that the Fed is supposedly going to maintain their relatively dovish stance and inflation is going to be calm. But the big thing right now, Frank, is this. You have, I don't want to call it Goldilocks because that's kind of a played out term, but almost a really perfect time, right? Mm-hmm. So what do we have going on? You have the potential for tax reductions, the potential for deregulation, potential for a very business-friendly administration. If you look at the picks that they put in, why is Bitcoin over 100,000? Because the SEC chair that's being proposed. Very friendly to crypto. And then finally, you have a Fed that's very friendly as well. Top it all off with a little bit of cherry on top on the whipped cream, and that earnings are really good, and the economy is strong. There is no landing going on. Package that all up, and you have a good stock market.
You bring up all good points. We've seen earnings season where, even earnings are coming out, like dripping out, retail earnings. We'll get to those in a minute. What I noticed, if you look at almost every single company, and I follow what you follow, we love following this stuff, right? We listen to conference calls and watch their earnings all the time. Yep. Dick's Sporting Goods, Pepsi, Coca-Cola, Chipotle just announced Disney, everybody's raising prices. When the Fed meets, 75% chance that they're going to cut 25 basis points. That's right. Favorable or not, but it comes to this point where it's almost like when people talk about deficits, eventually they're going to matter. Right now they don't. You'll see that in credit spreads, but it seems like inflation's starting to go back up here. And if it does go back up, you might not see it on the CPI because maybe rentals, which is all garbage and figured out, and real estate is 30% of that, which we always talk about. But what are your thoughts on the Fed? Is that a catalyst lowering rate? Should they keep it the same? Because stocks are just rocket higher, right? You see, companies are doing well. You're saying that the economy, if you look at the statistics they look at, not everyone's doing great in this economy. I get it. But with the statistics that they look at, they would say the economy is pretty strong right now. Even the job market is strong. But yet, right. Inflation, we saw what inflation could do to these markets in 2022, right? And it seems like it's going up. What do you think? Is the Fed, is there a shot that they do nothing?
To steal a phrase from my good friend Danielle DiMartino Booth, I am fed up with the Fed. The truth of the matter is that the Fed is I don't want to go so far as a Jim Cramer moment of they know nothing, they don't know what's going on, but they are just fueling and fanning the fire. What is happening is that somehow the markets got them by the tail. They're just following along what the markets are doing, what the markets are pressing. The Fed Fund futures at a 75% rate cut probability for in a couple of weeks from now. That's what markets want. Do they need it? No. Does the economy need it? I don't think so. Are we at above a neutral point? And if so, should we really be doing something about that anyway? I don't think so. I think that right now where we are with regard to the markets is a point where there is excess exuberance, stealing a phrase from someone else. And when we look at what is going on right now with regard to the economy, and adding to the fact of, gosh, we have to bring this up again, and I apologize because I feel like this is like part two, tariffs. We got to bring up tariffs again. And now tariffs are being scoffed off as, it's the art of the deal. It's simply a negotiation factor. Okay, but what about the tariffs that we have on already? You can't tell me, everybody forgot about this. I talked about this for years with you too. Tariffs are inflationary. There's no question about this, Frank. Tariffs are inflationary. And the truth of the matter is when we look at what's going on right now with regard to China, okay, yeah, we want to, make sure that they don't do things, but they're retaliating already. Palladium and a variety of rare materials are starting to slow down exports of, right? Because those make semiconductors and batteries. And we're seeing that even though Trudeau came down and kissed the ring down at Mar-a-Lago last week or so, he's talking about retaliatory tariffs. Mexico succumbing to the pressure, it seems, about border protection, but we'll see how that goes. I don't know if there's going to be fact or just this fictional idea of new tariffs going on, but Trump seems to believe that tariffs are actually paid for by the countries that put them on. They pay in a way, but the truth is we pay. And our payment, you and me, is all about higher costs. And I agree with you. I was sitting recently with an executive owner of a company, will remain nameless, a major company of materials, we'll call it, parts. And what was he doing? He spent the afternoon with me. We're doing things, but basically raising across the board all his prices on all his products, which there's a lot of SKUs, by 5%. Why? Why? Because his competition was doing the same thing. Did he need to? Not really. But his competition was raising. Why not? So these price increases by, you mentioned Disney, Pepsi, whatever, or shrinkflation, which they can't get away with as easily as much anymore because people are looking, is something to really be concerned about. And the Fed, just to bring it all, wrap it back up into a package for you with a nice bow, Frank, the Fed is making a very big mistake, in my opinion.
I don't know where I want to go with this because I want to talk about tariffs. I want to talk about the Fed first because I actually said this and I meant it. And I got, because it's almost like if you wore a MAGA hat like 2 years ago, you get rocks thrown at you like it was dangerous. I actually said, I think after the transitory comments that the Fed, Powell deserved an A+. And everybody ripped me apart because it's just common knowledge for everybody just say, we hate the Fed and I get it. But the criticism that guy received, if you would have told me that he's raising interest rates from relatively 0 to over 5% short term, you told me that, again, the transitory thing, it was a nightmare. It was the worst call that I've seen from anyone who ran the Fed. Okay, but I'm talking about after that, okay? If you would tell me he was able to raise rates the way he was and the job market would still remain strong, the economy would still remain strong, and you would see the housing market still remain strong, the stock market, everything. I mean, people were ripping him for raising rates, and people were ripping him for lowering by 50 basis points. We're at an all-time high with the markets. We're seeing earnings strong, and everybody keeps criticizing, and I get it. That's what you need to do. But it's just, do we give him a little slack? Because there's no one that agreed with this guy for the last 2.5 years. And if you look at the market conditions right now, there's not one person that's unhappy who's in the stock market, who owns homes, who owns assets. Yeah. And again, and he's raising, right? And you see the underlying, I'm not saying there's not money, tons of trillions pouring in from our politicians, right, with stimulus, but just, being able to raise rates like that in the face of everyone on CNBC, all these economists just criticizing hell at him, telling me he should do it. I just think the end result, I'm like, all right, if it's not an A+, I just don't think it's an F,
I love the fact that he reduced rates and he's really soft on the markets. I love the fact that he's, continuing being a big cheerleader. It's good for my business. It's good for my portfolio. It's good for everybody. Let's be honest about this, Frank. That's what we do. We're investment guys. We should be like, yo, Powell, cut another 50 basis points. Go, buddy. But the truth, But the truth of the matter is, I'm looking at a bigger picture. I'm trying to look at the bigger picture of what exactly is going to be happening moving forward a year and a half from now. I do not want to see a portfolio get spoiled and ruined. I don't want to see the markets get smoked because all of a sudden Powell's like, oh, we made a mistake. The reality is we should have been watching and looking at the things that were happening and the potential for what's happening, not really what was happening right then and there, but in the longer term. And I think that they get very short-sighted. They used to be really long-term, and they are to a point, but they become short-sighted and market-dependent, not data-dependent, market-dependent.
Definitely market-dependent, yeah. And let's talk about tariffs really quick because we have a playbook for tariffs in Trump 2018, and I was really against this because I did a really deep dive in it. And everyone went crazy in the trade war with China. It's going to be a nightmare. The market got hit, and I told everybody, I said, please ignore this. Just ignore us. It's nothing. Buying this pullback because when you really look at the underlying with the math, these current tariffs are a lot bigger than back then, by the way, and it's going to lots of other countries outside of China. But it didn't result in this trade war with China. It didn't result in our market getting crushed. It didn't result in this massive inflation for 2018. We didn't see that. So what happens if he does use this as a tool where I feel like we should be leveraging the United States, being the strongest country and the biggest buyer of goods in the world, we're letting everyone else get away with so much stuff for so many years, okay, regardless of what conspiracy theory you think about. But look how quick Trudeau came to the table. He was like the scared little puppy, He
came and he kissed the ring. He came down.
And he kissed the ring, but it opens up opportunities. But let me say if this happens, okay, there is big opportunities here. There's companies, right? You're looking at some large caps where 30, 40, sometimes 70, 80% of their revenue comes from overseas. It's going to be tough. They got to change their business, and some of them are doing it.
Right.
But I would think if this tariff, if it really goes through with this has to be fantastic for small caps, right? I mean, these guys do their business in the United States. It's going to be more money for the United States. It's also, I mean, does it result because we're looking at immigration where he's going to deport? Like, that's what he's going to do. That's what he ran on. If he does that, that should result in maybe slow economic growth, which means we're starting to see the dollar pull back. I mean, there's just what I'm trying to look at is say if he does implement these things, it seems like a dollar going lower is going to be very good for the market, very good for stocks, very good for American, very good for small caps. Are you looking at that way of how to play it if he really does follow through on some of these things?
It's also good for emerging markets, by the way. Dollar lower is very good for emerging markets in particular. Mm-hmm. Yeah, look, here's the deal. We can sit here and criticize and second guess and all that. Two things I want to mention. Number one, I've learned this over the last number of years, particularly over the last 10 years. The first thing is let's not invest on what we think is going to happen. Let the markets do that, but let's actually see the reality of the results of what happens before I really put my both feet in. That's number one. Because I think if we were to invest right now, you'd think deregulation, that's small caps. It's great. Well, we've had small caps anyway, but okay, small caps. If you think tariffs, okay, that could be good for small caps too, but it could be inflationary. That may be problematic for bonds. So what I would do is short bonds or go short duration. And I think rates, by the way, for the record, are going to be higher moving forward than lower. The only reason they go lower is a lack of.
I like that.
I would think that yes, I'm going to. There's not lower. I don't see lower. Lower would be a really big problem with the setup because in fact, if it's lower, that means he failed at everything, or that the markets and economy failed. That none of this actually came true. The reality of all the things we're talking about right now, the benefits of deregulation, the benefits of a lower dollar, the benefits of that's not happening. That's the only reason what rates would come down more. If everything is hunky dory, rates have to go higher. Because that would mean we continue on a growth trajectory of GDP. We continue on a growth trajectory of retail sales. Earnings are doing fine. All that's doing fine. The Fed is going to stand pat, and bonds rates will come down. And truthfully, I think that depending on how I would say adversarial the U.S. becomes with other countries, will depend on how our bonds are structured as well. At the end of the day, all that putting aside, we have a massive mountain of debt that somehow has to be resolved eventually. And there may be a little bit of a bloom off the rose with the idea that we could just carry this debt forever without some kind of reactionary response from maybe the bond vigilantes.
Yeah, and it's interesting. I love that take because I think a little different than you. I think rates would be lower. And I love always, and I don't want to bore people because I love talking. I love having you on because we can talk economics and it's great. And we take different, we try to make it as exciting as possible. Did
you just say you don't want to bore people? Wait, did you just say I don't want to bore people, but I love having you on? Is that what you just said?
No. Bore people with economics because I love this stuff. Me and you could talk about this for like 7 hours. And sometimes I'm like, do people interested in this? Because it has implications, right? If you're thinking about higher interest rates and you say that means the economy is doing good, higher interest rates is eventually going to crush the housing market because people are not.
Yes.
I mean, there's a supply problem right now and that's changing. You're seeing it with now there's more homes available on the market than a very, very long time, several years. And higher interest rates, I mean, you're looking at people, they can't move sideways because they want to move, even if they want to go from New York to Florida and get a discount. I mean, you're looking at 3% rate that they're locked in, 4%, most people, 80%. Are you going to go to 7%, right? So, and that's a huge jump.
And taxes.
I mean, so you're making up the
difference.
Right,
you have a $300,000 house you're selling. Right, you sell $300,000 tax with a $300,000 or $200,000 tax base, and you sell the $300,000 house for $700,000. You buy a house for $700,000. You got to start paying taxes on $700,000.
Yeah. Well, if you're primary residence, I think you have a $500,000 tax credit for that. At least I did.
No, forget that. I'm not talking about that. I'm talking about state and local.
Oh, okay. Yeah.
I'm talking about your
taxes are going to be, they got to be through. Yeah, $700,000 house. Of course. Yep. I know.
Right. $700,000 house. You're still paying 2% depending on where you live. So instead of paying the taxes on a $300,000, they may be like in some states you have a reduction. Maybe it's $250, 2%, which is $5,000 a year. You're going to pay it on $700,000, which is $14,000 a year.
Yeah. You talk about home insurance, you talk about auto insurance. I mean, these things are through the freaking roof, right? They're going up like 20%.
Very difficult to move.
Crazy. Holy cow. Yep. So let's talk about stocks now. Let's get into some retailers, right? Black Friday, you saw some of the winners. It was Amazon. I mean, you got the China and overseas companies, Temu. You got Shein. You have last report is Walmart. Amazon reported good sales. And I was looking at them like, okay, if these guys are reporting good sales, someone has to report bad sales. Not everybody's going to be good. And then we saw Target come out, which was not good. We think American Eagle and then Foot Locker, right? Because I was like, someone's probably not everybody could do good. What were your thoughts? I thought, there's some companies, some winners, some losers, anything you like in that space, because some of them are getting it done and some of them are clearly, falling behind. And I don't know if that's providing any opportunities for you.
So when you look at, for example, retail sales, doing a thing which is against the grain of what people thought was going to happen as rates came up, as concern about the economy, jobs. Again, another point that brings me towards the fact that things are fine from an economic standpoint right now at this moment. Time stamping right now.
Quick? You and I, since we've been doing podcasts for 15 years, and you've been doing a little bit longer, everybody has a podcast now. I think we're 0-15 betting against the U.S. consumer because we always how can they spend it? And every time they beat it, right? It's so funny. It's like,
every time. Absolutely. Never. That's the truth. The old phrase, the old adage, do not bet against the U.S. consumer. They will find a way. And if they didn't find a way, they'll invent buy now, pay later. They'll find a way. They'll find a way to grab the extra money inside the seams of their couch. They will spend money. So what's happening now is with regard to the retail earnings, Costco. I mean, it's about to be $1,000 a share. Home Depot. There was a theme to all these though. These are all good, right? Costco, Walmart, Amazon, Home Depot, Target, miserable. Foot Locker, you mentioned there. Lowe's, but they had a theme, and it was really interesting. The theme was, we did better than we expected, but you know what? The consumer is really slowing down. They're really coming to places to buying at lower prices. They're being more discriminatory. That was the theme of all of it, wasn't it? So I don't know if that's a sandbag or if that's reality.
Well, I want you to talk about this because you're really good at this. So when it comes to earnings, and I said Best Buy. So Best Buy last quarter, they beat estimates and the stock was at an all-time high. And that's all you hear as an investor, not you and I, but people, because we cover this industry. Everyone's professional at something. They're doing their own thing. That's why I listen to our podcast, Help Them Out. What they didn't realize is year over year, they beat the estimate, which is the consensus analyst estimates of the 30 guys that are covering, and they take the mean estimate, right? And they beat that on sales and earnings. But if you look at the earnings and the sales, they're declining year over year, both for Best Buy. And they bombed this quarter, but
it's not surprising. It's not surprising.
But the last quarter before that, I'm like, the stock, if you're seeing sales and earnings decline year over year, your stock should not be trading at an all-time high, right? You should not. I don't care if you're trading at 300 times forward earnings. If you're growing earnings and growing sales, you deserve the premium. When you're not, and this company deserves a premium, this quarter they came out and got hit. Talk about that a little bit because we're hearing, okay, you beat the estimates. But when you look at Salesforce, Salesforce a little bit lower, but they're still growing earnings by double digits, where some other companies are like, hey, we beat estimates where we had negative same-store sales of 2% instead of 5%, which is still not good, but you'll see the stock go higher. How do you play that?
So the hype machine is out there doing their job of doing the estimate versus reality. And what happens, as we know, is that the company is giving analysts their best estimates along the process, and they come in and beat it by a few cents usually, right? Maybe their outlook may be soft, but if their revenue right now, if revenues beat, everybody's happy. It's not so much about earnings right now. It's about revenues, which I don't know where the tide goes back and forth, but you can see it all the time. Like, oh, companies are beating earnings, but they're not beating revenue. Oh, that's okay. We'll give them a buy. Mm-hmm. I think the big issue though is that most people, and I'm not blaming people, I'll blame analysts, have become extraordinarily lazy. They're just looking at what's the estimate. It's easy. You beat the estimate, the stock goes up, and that's what the analyst gets paid for, right? If they can have an estimate, company comes a little ahead and the stock goes up, because most of them are sell-side analysts. Sell-side analysts get paid by their companies to pretty much make sure that the stocks stay elevated. And I think with when we look at this and we see that kind of scenario that you mentioned where we have declining sales. Now, by the way, that would not be allowed to be a stock that we buy. A stock that is declining sales on a quarter-over-quarter or a year-over-year basis, and it doesn't have consistency in revenue sales, or doesn't have consistency in earnings, raw earnings, is going to be excluded from screens that we utilize for our clients. Just not happening. So the reality will hit eventually, and they'll be the first ones, by the way, to get smacked when the market turns. Because remember, about 80% of a stock's movement is based on the market's general trend. 80%.
Is it really?
Something like that, yeah.
Yeah, because I know you have
attribution of stocks. That's the whole point of what's called mean variance optimization with efficient frontiers, and understanding true asset allocation based on modern portfolio theory. Talks about how essentially the attribution of returns are based on market things and what is outside of those. And most of stocks is all, but that's why you want to look at the overall market. What is the trend? And think about that before, you could have stocks that don't do well, as you talked about, like small caps that don't have earnings, breaking out in a really good market. Yeah. But they're the first ones that will turn lower when all of a sudden people are dumping.
Yeah. And I love you brought that out. I love bringing that out at you because I know you're analytic and have all systems in place and stuff like that through your money management style, which is great. And you said something interesting about the analysts there, Andrew, because the analysts, there's a big bias there, right? Because these guys get investment banking revenue. And if you're a company and you have, like Disney, and you have 32, 35 analysts covering it, whatever it is, and you're going to raise money whatever way, right, which they had to do before, not so much now, you're not going to go to the guy that has a sell rating on you, right? I wouldn't, you wouldn't, right? You're not going to. You're going to go to the guys that have a buy rating on you that's like, hey, we're going to really cheer your stock on. And they say conflict of interest and everything, right? So, you look at 2021 when, Disney still, I mean, it was 180, I think it almost went to 200, negative on Disney for a very long time. I mean, these analysts never changed their rating when it went down to the 90s. And it's like 110, whatever it is now. But, that whole bias in it, it's so hard because that, I'm explaining this, but as you know, because these are the analysts and these are the estimates that they're beating. And they're biased estimates. So when you really look under the hood, that's where you find the disconnect where, this might have beat the estimates and maybe the stock goes up a little bit. But when you and I, guys like us, look under the hood and say, okay, listen, the earnings were okay. They're still not really growing that fast. And they're trading at 35 times forward earnings and they're barely growing. They're growing 60% slower than the overall S&P 500. Yeah. So you're going to see that bump because it's exciting and you beat the estimates and, and they reiterate guidance. But a lot of times, you see these, you could predict a lot of times when you see these things are going to pull back or even vice versa. Some of them that just underperformed that really could really go a lot higher, by looking at that and take a close look under the hood, which is crazy.
Yep, I agree. But generally speaking, retail sales are good. I mean, just the only thing that I saw that was it wasn't a big problem. It was an issue was this idea that many of these companies are fetching, as I would say, concerned, worried about the consumer. And that commentary seems to be getting a little bit louder in the background recently.
Yeah.
That's the only thing I'm saying is a problem.
Yeah, I definitely heard that. So what are the sectors are you looking at? Because, you're looking at most of the sectors are higher, especially, another stocks are pretty close to all-time highs, and then Trump got elected and now, that Trump bump. But you're looking at underperforming because you see oil, biotech hasn't really performed well, right? Outside of if you got healthcare and some of the largest ones, especially weight loss drugs and stuff. Any thoughts on some of those sectors that have been underperforming? Do they look attractive like oil, where you had OPEC say, okay, we're going to just extend those cuts a little bit longer, and it seems like it's a lot. I've never really seen a market, this kind of booming market, where oil's not participating. Usually oil goes higher. And it's like, that's bad for everybody and bad for stuff. But you usually see that because the economy's doing good, oil goes higher. Right. I mean, it's like, more building, more everything. And yet, you see the problems in China. I'm just surprised that oil hasn't.
That's the relation.
Maybe that's, I mean, these companies are in best shape that they've ever been. They're paying dividends and great. Remember that when you see downturn in oil, a lot of these things would disappear and go on and call in bankruptcy. Now they have the fundamentals. They know the price. They turn it on, shut it off, but financially, they're very good. If you see oil go up to 70, 75, it's a little bit below 70 now, but if it goes to 80, you're going to see a huge jump, I think, in some of these names.
I think the big issue is China. Mm-hmm. It's not a sector I love. I think that if you look at the history and if we do any kind of outlook, when Trump came in last time, it was one of the worst sectors out there for a variety of reasons. Yep. You have the drill, baby drill, you have the fracking, all that, and all of a sudden it cuts down pricing or production is up, but yet maybe the spreads aren't as good for the refiners. And it just hurts everybody. So let's go to like utilities. Love utilities. You know what I love about utilities? We're in a great market. We have a reasonably high interest rate environment, right? Mm-hmm. And utilities are at an all-time high.
Utilities.
There's no way you and I could have guessed that in a million years.
Well, you might have been able to guess it about a year and a half ago. And I'll tell you why. Because utility companies, we've always looked at this defensive sector. These are the new growth companies. And you got to look at them as growth companies. It's not like I'm buying this at a dividend and I like it. It's not the old Con Edison stuff. These guys are on fire. And I've done a lot of research in this industry over the past 2-3 years. I have great contacts. I mean, you look at Constellation Energy, when you see some of these contracts, they're signing contracts that prices are increasing over 3 years by 75%. And the companies that are signing these are signing it in like 2 seconds because they're afraid it's going to go higher. Yep. They have total control. Right. There's a dire need for electricity through the AI boom, right? The data centers, people don't understand how much electricity we're going to need, and we're going to need it now. They're signing deals for nuclear, for projects, small nuclear reactors that aren't going to be available 7 years. I mean, there's only 3 of those in the world. People think they're not going to be 5 years. The approval you have to go through, the safety, local, state, federal, all that stuff. I mean, people who think that that's going to be produced or these things are going to be built inside of 5 years, you're crazy. And they're locking it in 3 Mile Island, locking in 20-year agreements after it's going to take 5 years to get the plant. That's how dire need they are of electricity. These are the nuclear companies. They really,
well, that's why we like Next Era, Southern, Exelon. You mentioned Constellation, which is more of a pure play on, I would say, on nuclear, which I like to call new clear energy.
Yeah. I never thought that would be the top. Never thought that would be the top story, like in the market.
It's amazing. Uranium. You were on uranium for a while.
Yeah.
You were on uranium.
We won it for a while. So, they've done very, very well. So, yeah.
Yeah. So I think that when we look at, the totality of all this and we look at that, I think it's a great play. We own all three of the companies I just mentioned in our client portfolios. And I think that, I think that we have to be very careful with some things, but financials, I don't see any reason why that can't continue to do very well into a two-part. Number one, a deregulatory environment that may or may not happen, but two, a bit of a reversion trade, where they have done very well. Look at the JP Morgans, the Bank of Americas, look at even a Wells Fargo that has a serial problem child in the industry. Citigroup just got a deal with American Airlines. What they've had it before, but with the sole credit card company. But all the, name the list, right? And the regionals to a degree. The fact is that there could be a reversionary trade there, a catch-up trade. That's very, very powerful. And it's been great. I mean, owning some of these names. They're not the ones that really hit growth portfolios a lot of times, but still, they're not as exciting, as sexy by any means. But I got to tell you, look at the charts. They're looking pretty good. But I think that could be a very beneficial place too. So the value side for a minute here, as we look at some of the pull forward effects that we've seen in technology, maybe in retail. Remember, a lot of people may be very concerned about the tariffs and going out and buying things right away. Like you said, with the utilities, they go in and they grab stuff right away. They kind of pull it forward, and that leaves a vacuum in the back once things change. If in fact we don't get the high tariffs that were expected, or they've gorged themselves on enough equipment that they don't need to buy anymore. So I think that's kind of important to look at. Some of the things that we looked at actually. I'll just throw a couple of stocks your way for a second. We've talked about.
I like you always have interesting names, and we track them. And you've done very, very well in this podcast, which I know myself.
So two of the names I talked about last time. Yeah, Toast. Talked about Toast.
Yep.
I think the last two times I was on, I talked about Toast. Get a little bit hot on the top end Toast right now, but this is the company that does. It helps restaurants be more efficient through front end, back end billing, payouts, gratuity management, ordering, so point of sales. So the whole process is pretty cool. Not cheap for the restaurant, but it creates an efficiency that's pretty dynamic. The other one that we talked about 100 times has been Palantir. We talked about that when you were on the show last time.
Yep.
Palantir broke out, the undiscovered AI name for defense, which was kind of like sitting there doing nothing. When I was like, what is going on? What is the problem here? Maybe they don't like his hair, Corp's hair, I don't know, something.
Yeah, it's just
but it's been on fire. Broke out since we talked about it.
That's Toast right there, guys. I mean, I pull up CNBC so I can follow along and stuff like that. And you guys,
look at that move since the last earnings.
I mean, that's incredible. Yeah, just in the last earnings. Look at that, boom. I mean, look at 25.38.
Yesterday there was a I think a couple days ago with that downstroke right there, they talked about how their numbers will pretty much be in line. What is this one?
Palantir. Yeah, we're in this at 24. People just they look at the valuation of this, and I said I made this mistake before, Andrew, with Netflix, and I was comparing that very early on with cable companies and saying it says it's astronomical valuation that could never fill, and I made a big mistake on that because I didn't realize that Netflix is the industry, right? All the cable companies together were competing with Netflix, kind of like with EVs when it comes to Tesla owning the whole market. This company, and I highlighted this, I think, on my podcast last week. Listen to the interview if you get a chance, guys. If you listen to this, of the Chevron CEO going on stage and not get paid, and with the Palantir CEO, and listen to what he said about Palantir and what it's done for that company, which is the second largest oil company in the world. Palantir has figured out how to use AI and increase profits dramatically, lower costs dramatically, efficiencies dramatically. That's a service every single company in the world wants. So when you look at valuations here, we've been saying, we have it since 24 and saying this is a $100 stock. We still think it. I know the valuation's crazy, but when you look at the total addressable market, it's much bigger than what people are saying out there. And that's why you've seen this thing really run. It's incredible. It's a good stock.
Now, the two of the best stocks that we have, you want to hear these names?
Go ahead.
AppLovin. You know that stock?
Yep.
Go pull that baby up.
Yeah.
That's ridiculous. Up 750% this year, up 480% since we've owned it, actually. A company that basically is talk about valuation stretch, but a company that is up another, God knows how much the last few days. But what's happening is they take, they help
This
to.
is a 3-month chart. Is that right? Is this a 3-month chart? This was 100.
Probably.
That's 400. Holy shit.
Could be. Yep.
Wow.
It's up, what, another 5% today? So this company, what it does, essentially, in a nutshell, it allows for developers of mobile apps to monetize, manage, and help create and then market their apps more efficiently.
$132 billion market cap. Holy cow! I had no idea it was that big. I didn't even know that this
it's
was that
humongous.
big. Holy cow!
Yeah.
Wow.
But what's his PE? Forward PE.
It's it's not too bad. I mean, what would you guess if you had to guess? I mean, it's 73. I thought it was. I mean, it's trailing. It's 118.
Yeah,
it says 73. That's if you believe the estimates. I mean, it could be cheaper if they blow out the estimates, right?
Right.
So it's all. But that's next 12 months.
The other stock that's been really good to us, which is another this is a bit of a mind blower here. UAL, United Airlines. Have you looked at that chart?
Yeah, these companies did well. I had Delta for a while and it got
123% in the last 3 months.
Wow.
3 months.
Yeah, look at that. Yep. On fire. I mean, these things are packed.
It won't stop. It's up another 4.
It's incredible. I mean, I fly Delta and I don't even, because if you fly Delta and I have miles, right? I have miles with a lot of these airlines and stuff. But if you really fly Delta and you go first class, it literally is like, it's almost at least 50% more expensive for Delta than to fly American Airlines or United if it's first class. I'm using like miles and stuff like that. It's just the prices, but it's incredible. I mean, these guys have pricing power. They have no competition. They didn't even they forced someone into bankruptcy and they bragged about it. The FTC, they forced
Spirit.
Yeah, with Spirit. And Frontier, right? So they were going to merge, and even with JetBlue, and they came in and said, nope, you can't merge. Why wouldn't you not allow those two to merge? They're like, well, we want to have discount prices available for everyone. They're going to raise prices. So, of course, they put one of those out of bankruptcy, which means these guys have even more fucking pricing power now. It's so amazing how our government was working, and they were bragging about it. Hey, we did this justice, and we made sure JetBlue couldn't. No, you didn't. You actually didn't. So, I mean, there's no such thing as a discount airline. You guys should know that. Even, is it Frontier that's creating first-class seats now? You know, I just flew Spirit.
Yeah. Matter of fact, I know the CEO is Spirit. And they just cut 27 routes. I asked them, I said, hey, you're going to cut a route? I was going to Guatemala from Fort Lauderdale. It's a really easy flight. And I tell you, we sit up front and it's next to $80 for the front seats, which is stupid. A little bit wider, but you get free booze and free food.
So let me get this right. When you're part of the 1%, you get to talk to CEO and he created his own flight for you. Is that it?
I don't know. I'm not the one that was talking about flying first class the whole time, buddy. You're the one that was talking about flying first class the whole time.
Oh, that's great. No, it's good to see. And I love when you give out names. What are some of the names right now, if you can give one or two out, that because you talk about past winners, you still like these things. Obviously, they're up a lot. Maybe they can go up a lot higher. But is there anything like off the radar that you're saying, hey, some of these things we might just got into? You don't have to disclose that, right? Because you have your clients.
So not right into, but I tell you, Crocs. Crocs is interesting. Pull that chart up.
Interesting.
Crocs leveling off. It went down to 95 and 93, popped back up after earnings. I think what's happening now is a direct response to like the Foot Lockers, the Nikes. People are saying, you know what, maybe we don't want to wear sneakers. Maybe that's out of vogue. For example, I'll give you like an Abercrombie and Fitch and a Gap. Like all of a sudden, who would have thought those stocks, GPS and A&F, are going to be doing so well, right? We own those too. But look at this. We saw this dip, right? Starting to rise back up. This was about $150 stock some time ago, came down to what, 90-ish after earnings. It leveled off and now it's starting to rock back up, starting to create a chart pattern that looks really interesting. And the fact is that Crocs, if you look at some of the things they have, I own, no, not the big things with gibbets, but your kids have gibbets?
Yes.
Crocs?
Oh, it's and they're like $5 each at these places. Yeah, you could buy them on Shein for like 50 of them for that amount. I mean, and they put them in their Crocs. It's just amazing. I mean, they have a very good brand, very smart.
I have the Crocs sneakers. Crocs sneakers are awesome. They're awesome.
Crocs sneakers.
If you look up Crocs sneakers, I think it's the Light Rider or something like that. They make them and a few others. They look like you wouldn't even know they're Crocs. You would not know they're Crocs. Wow. But they have the same Crocs material. I use them for when I'm boating, for example. They get wet. Who cares?
Yeah. Yep.
Right? This drains out, dries up real quick, antibacterial and whatever it is. But if you think about maybe like the Uggs and things like that maybe are doing well, Deckers, et cetera, that all flush down. But the real problem seems to be in the sneaker market. Maybe what happened is that whole, I think it's called StockX company. Are you a collector of sneakers, Frank?
I'm not a collector. Well, I mean, not a collector. I'm very aware of the market, though. It's just, but I am very aware that the sneaker market's on fire. It's just, this is the first time, I mentioned this last week on my podcast. I've covered Nike, they're great manipulating their earnings legally, just buybacks and stuff like that. I've covered them so long. Over those years, Nike always wins, no matter who goes against them, right? They always win. They figure it out. This is the first time there's an actual threat to their business where they're in a lot of trouble, and you're seeing it because they're.
You're talking about On?
You're looking at Hoka. Yep. Those. If you look at those sales,
well, Hoka's owned by Deckers. Just to be clear, it's owned by Deckers. 35% growth year over year. There's a good article in Economist. They're taking market share, and Nike has not had that innovative edge, those commercials and their clothing isn't doing that good. It's just, you see it in the stock price. And now look what Foot Locker just said when they reported. So these guys are reporting, I think, in a couple of days on the 19th. Foot Locker's like, that it crushed us. They basically said sales of the Nikes were terrible. And this is a sneaker brand. I played basketball in my life. They were it. And now I'm wearing things outside of Nike myself because these are very comfortable sneakers and very nice and cool, look better. And I don't know. I think they're in a lot of trouble. So it's funny because I went the opposite way. For years, I had kind of a wide foot, so I always wore like New Balance. I'd wear a bunch of, like all sorts of different brands, right?
Yep.
But all of a sudden, I don't know, maybe I got older, maybe I lost some weight and somehow I lost weight in my feet. I don't get that. But nonetheless, I'm all of a sudden could fit into Nikes and I love them. Yeah. I have a whole slew. As a matter of fact, Frank, I encourage you and your listeners and your viewers to go look at customizing your Nikes. There's a really cool app online that you go in and it's like, 25 or 30 different points of customization. One of my shoes says Horo and one of my shoes says Wix on the other side.
and you're using them playing what? What are you playing now that you're an expert in that you play that?
Pickleball.
Pickleball. I got to be getting into it.
Actually, I do. I have my Nike pickleball. Nike is my pickleball shoe too.
Yeah. I mean, look, if I play basketball, I've had a couple back surgeries and hip replacements, stuff like that. And I still love basketball. I'm still shooting around, but Nike's my go-to. But when it comes to walking, I don't run, but just if my normal sneakers used to also be like dark Nikes or maybe New Balance. And I switched to Hoka and On. So, but yeah, the sneaker.
So no kids anymore?
No kids. My youngest daughter likes those kids though. They came back
of course
into
they like
for a
them.
little bit. That was a big, worst fashion. Sneakers I always very passionate about, I'm very particular about them.
Watches. You know what the kids are wearing now?
What?
Casio LEDs and LCDs.
Really?
Big thing. Go look, start watching. They're just wearing these things. They don't care. It's like $17. You remember those, the old LCDs?
Yeah.
You bang them up, you pick them underwater, you screw them up. Who cares? You get another one for $17.
Yeah, that's good. It's good to see. It's really good to see. Wow, lots of stocks there. Okay, so before I let you go, tell me if people want to learn more about you and talk about your management portion of the business, which we talked about a month ago, because I was very, listen, I love you, man. I hope you have billions and billions in management, but it seems like things are going very well. I know that because your performance and stuff like that, but also talk about that in your business, because I know you do something that we don't do is you manage money, and clients that have come from me and gone to you have done very, very well. You always got good stock picks. So talk a little bit more about that. Yep.
So thank you. Anybody that would like to come on board and check out what we're doing, the bottom line is it's a very easy process. If you don't know exactly where you are, what it is like working with an advisor, working with someone else, if you're concerned about it, we make it really easy. You go over to the disciplined investor. Frank Curzio is on the screen right there.
That's a really good looking guy.
Frank, look at that. Frank, looking good.
I actually did not plan that. Actually, did that come right? Oh, it's part of your slide slow and everything. But yeah, go ahead.
Yep. Go over to the contact us page somewhere on there.
Okay.
Basically, you go over to contact us. You just drop me a line, and what we'll do is we'll set up a meeting, talk about it. We'll do a secure upload for what's going on with your portfolio. Take a look. Sometimes you're doing great. We'll just say, hey, you know what? With nothing we could do for you. Sometimes we have one of our strategies that may work out, like our TDI managed growth strategy, which is a lot of the names we talked about today, and our global allocations, which are more of a diversified, long-term U.S. equity, fixed income strategy that will give you a really good in-depth view. We rebalance it. We use all the different tools of modern portfolio theory. I make it easy to work with me personally, and I think that it's something that you'd really enjoy. So go over to thedisciplinedinvestor.com.
Andrew, as always, love having you on. Love the picture. We've been friends for a long time, and my audience loves you. So you're more than welcome. Come on whenever you want. And thank you so much I know they thank you for the picks because you always have really good stuff to say and everything. So I really appreciate that, buddy.
Frank, you're the best. Big hearts, big Whatever the part.
All right, guy. Thanks so much for coming on. I appreciate it.
I love you,
Talk to
buddy.
soon.
Have a great holiday. Hey, have a great holiday and a great new year.
You too. You and your family, man. I'll talk to you soon.
Thanks.
All right. All right, guys. Great stuff from Andrew. Awesome. Love him. Been a friend a long time. He always sends me pictures, everything, man. It's really, really cool. So, yeah, questions, comments, frankcurzioresearch.com. Anything else, feel free to give me a shout. Otherwise, I'll see you tomorrow on Wall Street Unplugged Premium with the one and only Daniel Creech. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. Including the big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.